Welcome to Your Money, Your Call. It's the bonds edition. I'm Mark Top in the NAB. I'm joined by Roger Montgomery from Montgomery Investments. How are things for you?
Well, as I said during the introduction, when people couldn't hear us, it's just incredibly hectic at the moment. So what I see happening is a shift in sentiment towards many sectors in Australia. A lot of them either being disrupted and challenged or just being challenged cyclically. So there's either structural challenges or cyclical challenges, and that means as an active investor, you've got to be very thoughtful about the prospects for various industries and companies in those industries. There's not a lot of places to hide at the moment.
Yeah, so I want to talk about that because, I think the one theme I've got at the moment, two things I'm looking at the moment is the inflation story and then the artificial intelligence story because, being at the NAB, we're meeting all these companies that want to disrupt. And, okay, how do you expect to do that? The front and centre page that everyone spoke about was Monday's edition of, I think, a company's called Altair. Mm-hmm. And what they were closing down. Yeah. So they were. I don't know the gentleman at all, and I have no dog in the fight. I don't care. What people do with their money is their business. I was intrigued by some of the commentary around it. So you might have views on markets. When I heard that they were closing down, I thought two things. One was, I'd like to get the idea that you guys might have in terms of if you saw assets as being overinflated, is the solution to close down, or are there other tools available that you could use to say, look, I'll take advantage of my view? And then the second part was, having delivered the cash back to the clients, what did we actually expect them to do? If you're the professional fund manager. So, Roger, if you have a view on markets like that gentleman has, what do you do? Do you close it down?
Well, one of our view isn't cataclysmic, and his is. He's arguably working with Gerard Minack, who's a perma bear.
Yep.
That if he's in your ear every day, there's probably a cataclysm coming around the corner any minute.
Yep. So you knew that in advance. When it's not like Gerard only arrived yesterday, so he's been in the market for a long time, and everyone knows that. So if you have him on that investment committee, that's the role he plays, which is very strong. And you say, I understand where you can see dark clouds where other people can't.
The first thing is there are dark clouds that are of a geopolitical nature or political nature or a legal nature, almost always temporary. So you take advantage of those opportunities. You don't worry about those at all. They pass. The structural changes in an industry you are more concerned about. So, for example, in supermarkets in Australia, the arrival of Aldi and the compression of margins and the loss of market share and the operating leverage working in reverse, they're things that you are concerned about. Clients pay us to navigate those things. They pay us in expectation that, one, will protect their capital and two, will grow it over time. And so handing them the money back is, it's not always the right response. It doesn't seem fair to a client who's paid your fee.
Fair. That's what stood out to me.
So what we did is we deliberately thought about this before we set up Montgomery, and we decided, and it was unusual for the time, we wanted a mandate that allowed us to be very flexible in terms of how much cash we can hold. I didn't care about researchers at the time. I didn't care about consultants. I didn't care about strategic and tactical asset allocators, because I believe that's like saying, well, I've got the gift of working out which asset class is going to be the best in the next 12 months. Quite frankly, no one does. So instead I said, well, I'm the guy at the coalface. I think I'm best positioned to decide whether the market's expensive or not, and so I want the ability to hold cash if I find it expensive. Now, the common refrain is, yes, but I'm not paying you to hold cash. Now, that's true, but what you are doing is you're paying me to navigate when the right time is to be in equities and when to protect your capital and be out of equities. And if you told someone at a dinner party that you've got a phone number of a guy who does that successfully, they'd all want that phone number, and so there's value in that. And so that's what we've done. Now, it wasn't very popular at the time, but it's becoming increasingly popular. To Phil's credit, he did give people the option to go into, he recommended some other fund managers to invest with or to take the cash, and it was the clients who opted to take the cash.
Yeah, and I have no, like I said, I have no view on the gentleman. I'm just talking about the concept that then ran hard in the paper. It generated a lot of calls at the NAB, and I said, I'll take all those calls, no problem. I'm happy to talk about optionality. I'm happy to talk about the concept of what you look for in a fund manager. And I think to some extent, the fund manager needs to have a strategy. You both described it, and I think that has to be consistent with the idea of what the investor wants. In other words, I can't take any vol, then you should be in cash, or whatever it might be, but you've got to work out your own plan, don't you think?
And yes, you appreciate that there's been articles since that announcement that suggest that there are various other reasons.
I'm not, like I said, I don't want to
Whether they were right or wrong,
Yeah.
I don't know. But if you do have that view on markets, as you rightly there's a bunch of options available to you.
So what do you think of markets at the moment?
Well, it all started to get a bit silly earlier this year when Austria issued a 70-year bond at 2.03%. And you ask yourself the question: is there going to be a credit event in the next 70 years? Are interest rates going to rise in the next 70 years? Is there going to be fears of inflation in the next 70 years? Yes, and you're locking yourself in for these really low returns. So a lot of long duration assets, people are locking themselves in, accepting bond-like returns but taking on extraordinary risk, and that always ends badly. Those two things don't coexist for very long. And then more recently, there were two anecdotal examples of the end of...
Can I just make one... I just want to clarify one point. When you talk about Austrian bonds, 70-year bonds, and you talk about extending duration, just to work out, what duration are we talking about? Are you talking...
So I'm talking about 0.8 of a year. I'm not talking 70 years.
You're saying going out a year or two.
Yeah, just having a little bit of duration.
And you're saying the illogic of 70 years is not something you want to be locked in for 70 years. So that's fine. So we're talking valuations, we're talking about what do you think of it. What do you think of the valuations in markets at the moment?
As I was saying just before the break, so we're seeing some unusual events, and the Austrian bond, for example, and then closer to home, we've seen assets that produce no income starting to smash records and pre-auction estimates. And I always think that happens at the end of a credit cycle.
Houses.
So, for example, in the United States, houses are one, residential real estate. You always ask, it's a rhetorical question, but why are there no listed residential REITs in Australia? It's because there's no income, right? And there's no return, right?
Okay.
So that's bizarre. So anyway, so you saw a couple of weeks ago a Basquiat painting in the United States, which was painted after 1980 by an American artist, broke all records, was sold for $110.5 million US, a record for an American artist, a record for a post-1980 painting. And then closer to home at Shannon's in Sydney, we saw 2 weeks ago a number 29 New South Wales number plate, 2-digit number plate, pre-auction estimate $450,000 to $550,000, sold for $745,000.
Right.
So I said earlier, I made that comment about cash being a liability. When people see cash earning 2% as something that's no good, and you're better off in buying things that go up even if they don't produce income, then you're towards the end of the credit cycle. And ultimately it's going to end badly. Now what we did is an analysis. We run intrinsic value calculations across the entire market and across every single stock. And when we value the market, the universe of high quality businesses that we would look at, valuations today, or market prices today, are at the most extreme they've been compared to intrinsic value since before the GFC. So it's expensive right now.
Does it seem like the lower cash rate hasn't done what they have? The economic textbook's been thrown out. Maybe because...
Definitely didn't work. It didn't work. So taking rates to zero didn't stimulate the economy. Flattening the yield curve through quantitative easing didn't stimulate investment. It had the reverse effect. Everyone hoped, all the central banks in the world hoped that by raising asset prices it would increase the wealth effect and then everyone would spend money. All it did was increase asset prices.
Yeah.
People aren't spending more money.
Yeah.
And so corporate world would have theoretically borrowed money, retooled, and then become more productive and made more money and sold the widget at the same price. That's what they do in Japan. That hasn't happened either.
Well, more than 90% of the debt that's been accumulated since 2010 by non-financial US corporates has gone into mergers and acquisitions, special dividends and share buybacks, not for productive use.
Yes. And is there an element that says that this is part of the demographic shift as well? Or is there a bunch of forces playing that says we're not using as much because we're all getting older? Slowly but surely the world is getting older, so they're not buying all the new houses or whatever. They're not spending that money. We're not seeing the same growth in the consumer usage of money. Is that changing? It's going into retirement homes, that sort of stuff. Is anything about that story?
If that were true, you'd see it reflected in lower PE ratios because retired people move into a decumulation phase from an accumulation phase. So as the proportion of people over the age of 60 versus the proportion of people under 40 shifts in favour of the 60-year-olds, then you should see prices contract for assets. Now that may yet happen, but it should have already started happening, and it hasn't. In fact, it's gone the other way. So I would propose that what's actually happened, and I'm just guessing here, is that we've seen a shift from wealthy nations making money out of manufacturing to emerging economies making money out of manufacturing, and the wealth being concentrated in those countries amongst fewer people. And so there's a reallocation of assets to, and that's how capitalism. That's how capitalism works. If you let capitalism run to the end, you end up with a handful of people that have all the money. Yeah. So, and that's what we're seeing. That's why Bill Gates talked earlier this year about taxing robots, because the idea of a universal wage for people who are just going to permanently be unemployed. By 2030, 7 million people are going to be out of work in the United States because they're not going to be needed to drive a truck or a bus, or a van. And so, what are they going to do? You've got this universal wage idea, and therefore, how are you going to pay for that? Tax robots. Otherwise, you end up with all the wealth in the hands of a few people. Blockchain is a ledger. It's a ledger system. Bitcoin is one of the first examples of that ledger being used. And so a lot of people don't understand that. And I agree. I think the issue is going to not be for banks in the first instance, but it'll be for companies like Computershare and share registry services and anyone that's anyone that deals in the collection and maintenance of data between disparate parties.
So where do you see, in terms of that argument around active versus passive? I'll go to Greg second because he has some insights on what his concerns are, but you're an active manager. How do you see the active versus passive play out? Because at the moment, Vanguard is a £900 gorilla. Everyone goes to those passive funds. There are CalPERS bang on about how great it is. I don't pay any fees, okay? And I think Warren Buffett has said, just buy it if you don't know it. I think the guy that runs CalPERS is supposed to know it, so I don't know whether he has the... But whatever, not for me to judge.
Yeah. It's one view is, and just remember, I am an active manager, so therefore you're asking...
I disclaimed on your behalf. I said you were an active manager.
Turkeys don't vote for...
I think I know where you're coming from. I just want you to win me over because I'm going to put a dollar into a passive fund.
Here are a couple of points that I've done a lot of reading on the subject. I am concerned about a few things. We did some work on the Australian market, found a similar experience to what's going on in the United States. So let's suppose it was... This is a great example. Let's suppose it was 2013 and I've come back in time to you from 2016 and I told you that over the next 3 years ExxonMobil was going to see a 50% decline in oil prices, a 76% decline in profit, a 46% decline in revenue. Its debt was going to go up 130% because that's how it's going to fund its dividend, which is exceeding its profits. Would you short that stock? Or would you go long?
I'm shorting as we speak, but you're going to tell me that I've...
It went up.
Yeah, I've just done my money.
And so McDonald's, Coca-Cola, ExxonMobil, all of these big stocks that dominate the indices have gone up in price despite deteriorating fundamentals. That can only be the result of index investing, which as they get... The economics of index investing is such that as they get big, they're not very... they don't make huge... They don't have huge fees, and so they need to be big to be economically viable. Once they get big, they have to concentrate on the large stocks in order to get set. And in August 2015, there's a high yield fund in the United States, I think the code's HFY. And what we saw there was in one single day, we saw a 2% shift in the NAV of the ETF, but a 35% decline in the unit price of the ETF. And the reason that's the case is, in the case of ExxonMobil, you've got 90% stock turnover per year, right? So all the shares 90% of all the shares turn over every year. In the case of SPY, which is the biggest index fund in the world that tracks the S&P 500, you've got 100% turnover per week, or 3,500% a year. Now, it's all fine when the market's going up. When the market's going up and money's flowing into these things, these ETFs, it all's going to look good. My question is, what happens when the market turns down, people want to get their money out? You could see a lot more volatility and the very idiosyncratic risk that people wanted to get out of it, which is why they got into index ETFs to begin with, could be the very risk that they're jumping back into unwittingly.
Okay, so where do you see value at the moment? Where do you see the opportunities? Where would you... Is it just in cash? Is that the only opportunity?
Well, there's some interesting individual opportunities, so it's hard to use a broad brush. For example, in healthcare, some healthcare stocks have been sold off very, very heavily. For example, Healthscope, because hospital volumes, or what we call separations in the medical space, which are completed operations or completed medical procedures, they're slowing down. Part of the reason they're slowing down, and we don't think it's entirely this reason, but part of the reason is that state governments have been pressuring state-run public hospitals to clip the ticket on patients that come in on their private health insurance, as well as the money they get from the MBS through the federal government. So they're double dipping. Now, the problem with that, of course, is that people who can afford to pay on their private health insurance should not be in front of the queue in a public hospital before somebody who can't afford private health insurance. So there's a moral hazard associated with that, and we think that might persist for a little while yet, but ultimately the government's going to crack down on that, and we'll start to see volumes flow back to private hospitals, and we'll see those pick up because we know the population is ageing, and the biggest contributors to separations in private hospitals for elective surgery are the 74 to 85 plus cohort, the fastest growing cohort in the Australian population.
It's had a massive rally over the last, well, sort of lots of volume in May, and it's really kicked up of recent times.
Yeah, but you'll remember in September it came off almost 30%.
No, I can see with the chart. I don't know whether people can bring up the chart. It's HSO. It's a very steep chart moving up in the last...
Yeah, it sold off pretty heavily. It sold off pretty heavily in September, and the reason it did that was because Rob Cook came out and for some reason said that, you know, it was a curious statement, but he said we're seeing lower volumes in the September quarter. And if what we experience in September goes on for another 9 months, then we'll see no EBITDA growth. And the market was expecting 10%, so of course they repriced it. And it came out in the half-year results, it was 5.6 or 5.7% EBITDA growth. So it's back to sort of roughly normal.
Did somebody go and slap him around for saying that?
It was odd.
If something happens for the next 9 months, things will be really bad. But okay, so look at the way that has fallen apart. But for the viewers, the thing that I was looking at is the shape of the rally, the recent rally. I'm not saying it's a buy, obviously, you know, disclaimer away. But if I look at the volume, there's some pretty big volume that is taking place on that equity. So maybe
there are issues around. There are still issues, for example, around rebates for prosthetics. So, for example, there's an inquiry that will be, you know, August before we see the results of that inquiry.
But in terms of the charts, you need to see it get above that, you know, that 220, and then you've got some comfort around.
Charts. I don't know what you're talking about.
Well, you can see it's common sense is telling you that a lot of people have been playing around in that space since the fourth quarter 2016 to now. You can see it's, you know, fighting hard, and now it's popped up. So it's a question of whether, you know, Mr. Clark or whatever his name is has said, okay, hang on, we are going to get. Mr. Cook says we are going to get some growth. So that's obviously something to put on your radar to say, let's just see how that performs. So
yeah, we think that is just the bit of paper that wiggles and jiggles on a screen, and we're interested in the underlying business. And we think in the long run the business will be significantly more valuable than it is today. But there are issues. So, for example, one of the issues is that if the government cracks down on manufacturers of prosthetics, for example, and they get lower revenues, they pay a rebate back to the hospitals, and it's all a little bit murky about how much of a rebate or what proportion of hospital revenue is rebates from manufacturers of these things, and so that could crimp their margins again. So we need to see all that play out, but we know that the structural trend is in favour of admissions to private hospitals.
You've got global funds. Where are your funds?
We've been very fortunate. Just a quick little plug for the team. Andy, Chris, Dan and George run the Montgomery Global Fund and the Montaka Global Fund. And the Montgomery Global Fund, on the one-year numbers, has ranked number 4 out of 475 funds.
Who ranked them?
Oh,
is it by absolute number or
this is Australian global? This is global funds offered in Australia, and the only 3 that beat them were geared funds. So we have no gearing. So out of the ungeared funds, this fund was number 1. So congrats to the team.
What number? What did they do?
27%.
Okay.
In the one year return, and that's with 20% in cash over the course of the year. So
what did they buy?
Well, lots of platforms. So where we see a lot of value and where we think a lot of investors are underestimating the opportunity is in businesses like Tencent in China. Tencent owns WeChat. It owns the biggest online gaming platform. It's the biggest online banking platform. It's the biggest social media platform, and it's second to Alibaba in terms of e-commerce. And yet it's really just being valued on its core business, which is its mobile telecommunications business. The rest of it, it's all optionality. You've got businesses like Facebook. Facebook owns
Just to clarify,
Snapchat.
please, I want to take this slower.
Yeah.
In terms of the Chinese investment, are we, NASDAQ, where are we buying this? Is it a dual listed Hong Kong?
Hong Kong.
In dollars or what currency?
Hong Kong dollars, or
Okay.
it depends on the stock, but Hong Kong dollars or US dollars?
You bring it back into the currency of choice?
It stays in US dollars. We're unhedged and in US dollars.
Right, okay. And how much of the performance over the last year was dollars? How much was that?
Yeah, that's a good question. I'd like to say it was about 8% of that 27%.
Okay.
Yeah.
It wouldn't be the bulk of it, though.
No, absolutely not. No.
Yeah.
And so then you've got businesses like Facebook. You know, Facebook has 1.9 billion monthly average users, and then they've got Snapchat. Snapchat has 1.2 billion users. They've got Instagram. They've got all of these platforms, yet they haven't monetized anything except for Facebook yet. You know,
Right.
It's just absolutely remarkable.
And they know how to make money.
Sorry?
And they know how to make
They do
money.
know how
They know
to
how
make
to
money.
charge.
Yeah, it's incredible. And, you know, I don't want to take all the wind out of Greg's sails, you know, but there's lots of businesses like that. We own a business in the United States that has 90% global market share in rear vision mirror technology. You know, all of the rear view mirrors in
so
cars.
backward looking. I'm an SMSF investor. Can you provide greater granularity on what you're looking at? I don't know. I know you don't provide advice, but what is catching your interest as an investor? Is there anything other than what you've just spoken about? Maybe, you know, the sort of the black swan events that are catching your eye as an investor. So in other words, as an SMSF investor, I think everything's working well. Oh, I didn't think that was going to happen. So is it Fed fund rising in June and higher rates in the US? And like what are you looking at?
What's keeping us up at night?
Yeah, to sort of...
Do you want to go first, Greg?
Yeah, well, yeah, why don't you go first?
Okay. So for me, it's Australia that's keeping me up at night at the moment, and quite specifically, 9% of the Australian workforce is employed in the construction industry, the residential construction industry, and that is now peaking. We saw approvals drop 23% back in October.
Driven by the banks.
We know that there is a 10-month lag between housing activity and renovation and addition demand and products related to that. So we know already that it's coming off the boil. This is activity, not necessarily prices. We'll put prices to one side for a second. When that activity comes off the boil, there are a lot of contractors who are going to be underemployed. That means less retail sales. This is in the absence of Amazon. Forget about Amazon.
Yeah.
It's a bigger threat than Amazon. And then the retail sector is the second biggest employer in Australia. So you've got the construction industry and the retail sector all coming off the boil at the same time. Then you've got Amazon joining as well, which is going to put pressure on market share for these companies. And a lot of retailers, forget about margins, but just losing market share at the same fixed operating cost because of their leases on the stores, that's going to put them at a major disadvantage. We're already seeing in the United States 50% falls in foot traffic in malls just over the last 3 years. And that's because of Amazon Prime.
Internet of everything.
52% of households in the United States have Amazon Prime, and it's coming here before the end of the year.
What is Amazon Prime?
Amazon Prime is one button purchasing and same day delivery.